Hello, in this session what we're now going to have a look at is the disposal of non-current assets. Now think about the life cycle of your tangible non-current assets. You've recorded the initial cost, debit non-current asset cost, credit bank or some other payable or loan liability. We've then looked at the subsequent accounting treatment of the non-current asset. That was through depreciation. Writing down the value of the asset year on year, okay, to reflect the consumption of the asset. So remember, when we're charging depreciation, we can use straight line or reducing balance to estimate the amount. But the journal entry was to debit depreciation expense and credit accumulated depreciation to reduce down the value of your asset. So we've looked at the asset, we've depreciated it. Now what we need to do is get rid of it and dispose of the asset. So, a disposal of the asset then. Well, when we think about a disposal, we need to think about several things. Well, if we're disposing of the asset is no longer going to be in our books anymore. So we need to remove the asset from our books. What we also need to think about is thinking about, well, what did we dispose of the asset for? Did we receive cash in return from selling that asset? Or did we trade that asset in for a newer model? And as a result, got a little bit of a reduction in the cost price of the new asset by that part exchange. And then when we think about it, we think, okay, well, I've sold the asset for, I don't know, £2,000, but I'm removing it from my books at its carrying value, which may only be £1,000. As a result, I may have made a profit or loss on disposing that asset. So in this example, clearly I've made a profit of £500, okay, because I got £500 more than its carrying value in my books. And really, when we're thinking about disposals, we're thinking about removing the asset, recording the inflow of cash or a new asset if we're trading it in, and then ultimately thinking about whether we've made a profit or loss on the disposal as a result. So, let's have a look first then at this idea of a profit or loss on disposal. Now, when we account for a profit or loss on disposal, we need to calculate the value first. So, as you can see in this diagram, which again, you must learn, we're going to start off with the sale proceeds of the asset. Now, those proceeds is what I receive in return from selling the asset. So that could be cash or a part exchange allowance. Okay, so I'm either going to receive cash in return from selling that asset, or I'm going to receive an allowance or a reduction for a new asset that I'm going to trade in. Now, sale proceeds then, I'm going to pop that in first. What I'm then going to compare what I sold my asset for to is its carrying value. So remember, the carrying value of the asset is the cost minus the accumulated depreciation to date. Now remember, that's the carrying value of the asset at the date of disposal. Okay, so that's very important, at the disposal date. And that's going to be compared and taken from the sale proceeds. Now, as a result, if you have a positive figure dropping down in the bottom, well, you have made a profit or gain on disposal. You clearly sold the asset for more than its book value or carrying value. If the figure at the bottom is a negative figure, well then that would be a loss on disposal. We sold the asset for less than the value that we are carrying it at in our books, so in our financial statements. And that's it really, that's how you calculate a profit or loss on disposal. So learn that and make sure you do lots and lots of practice to make sure that you're happy with that working. In the exam, for a small 2-mark question, it could say calculate the profit or loss on disposal. If you remember that, you can't go too far wrong with it. Now, when we thought about the profit or loss on disposal, we then have to think about the journal entries that we need to enter into our books and update our accounts accordingly. So, for this, what we have is a 3-step process. Okay, 3 steps. Now, disposals. Okay, we've got our disposals head on. Think about what we're doing. You're getting rid of an asset. You're removing it from your business. As a result, that asset no longer exists in your business. Therefore, it should not exist in your accounting records. Now, what we have in our accounting records for the asset is its original cost in the asset cost account and all the accumulated depreciation on that asset that no longer exists. As a result, we need to remove them and essentially reverse the double entry that you would have seen before. So, step 1 then for a disposal is to remove the cost of the asset. Now remember, the asset cost account would have a debit balance. Now I've been very careful to show you the T accounts and how they work. In the asset cost account, there will be a debit balance representing the original cost of the asset. Which means then that we need to remove that debit balance and reduce that asset cost through a credit entry. So I'm going to credit the non-current asset cost account to reduce the value of my asset down and essentially eliminate that debit balance for the asset that no longer exists in the business. Now, dual effect says that every debit must have an equal and opposite credit. So every transaction has that dual effect. So the debit entry will simply get put into the disposals T account. And that's just the opposite entry. So when you're learning this, just remember, remove the cost, credit non-current asset cost. The corresponding opposite entry will always be to disposals. So we've done that. Step 2 is to remove the accumulated depreciation. If you no longer have the asset at cost, you no longer have the accumulated depreciation associated with that asset. So you need to wipe clean the accumulated depreciation account in relation to the asset that no longer exists. Now, accumulated depreciation acts as a way of reducing the asset values in the statement of financial position. So therefore, it would always be a credit balance. So, to eliminate that credit balance, I need to do the opposite. I need to debit it out to clear it. So, I'm going to debit the non-current asset accumulated depreciation account to reduce that down, clear it out. Now, if you've debited out accumulated depreciation, it no longer exists. Well, the corresponding entry must always be to, you've guessed it, disposals. So if you can remember the debit to accumulated depreciation, the credit will always be to disposals. So step 1, remove the cost. Step 2, remove the accumulated depreciation on that asset that no longer exists. Now, that's step 1 and step 2. Step 3 is to deal with the sale proceeds. So, from selling that asset, you've got rid of it from your books. What are you receiving in return? Well, if we're receiving cash in return from disposing of that asset, great. If I'm receiving an asset of cash, I'm going to debit the bank account to increase my asset of cash. Okay, I've got that asset of cash in my business. There has to be a corresponding credit entry. Well, again, it's obviously going to go to disposals. So if you remember step 3, debit bank with the cash proceeds, the credit will always be to disposals. Okay, so there we have it. That's the 3-step process. Remove the cost, remove the accumulated depreciation, and deal with the sale proceeds. Now, this is dealing with sale proceeds if you've sold that asset for cash. But what if your proceeds are actually a part exchange allowance that reduces the list price of a new asset? Now, in that case, step 1 and step 2 would be the same if you have a part exchange, but there will be a slightly different step 3 if you have a part exchange. So, if I'm selling my old vehicle to a car dealership and I'm receiving a new vehicle in return, well, usually I'd receive that vehicle in return at a slightly discounted price to reflect the fact that they've now got my old asset, my old vehicle. Now, what I'm receiving in return in this case is not cash. I am receiving a new asset. So, first thing I'm going to do is debit the asset cost account for that new asset. And that is going to be with the list price of those goods. Okay, so the physical list price of that asset. Obviously, you are going to have to pay some money to acquire that new asset. So let's put some numbers to this then. Let's say the list price of the asset is $18,000. And you trade in your own vehicle in receipt of a new vehicle with that list price of $18,000. Now, you've traded in your own vehicle and the dealership has said, okay, well, as a result of you trading in that new vehicle, that old vehicle, what you are going to receive is a $2,000 discount on that list price. Which means then that what I have to pay in cash must be the remaining amount, the $16,000. Okay? So the physical amount that I have to pay to acquire that new asset would essentially be the list price less the part exchange allowance of $2,000. So again, crediting bank to reduce down your asset of cash, because obviously you would have to pay some cash in order to acquire that new asset. Now, we then have to see and appreciate that there's a difference. The debits does not equal the credits by that allowance of $2,000. And that allowance is the proceeds from disposing your old asset. So that $2,000, we're going to credit to disposals. Okay, that is the proceeds from disposing your old asset. But rather than receiving cash in return, we're receiving a new asset with a list price of $18,000. Notice then that your debit to the new asset cost will equal your credit to the bank and the disposals. But with a part exchange, remember, the step 1 and 2 are the same. So you still need to remove the old vehicle at its cost and remove the old accumulated depreciation. Again, on the old vehicle, you're just going to replace it with a new one. So that's an alternative step 3 if you're asked to deal with a part exchange. And there we have it. That is the process to disposals. So in our next session, what we'll do is we'll have a look at an example just working through this idea of this 3-step process, and we'll see what a disposals account looks like as well. Okay, thank you.